Okay. So we first reviewed some of the fundamental topics, right? This cost accounting fundamentals, you guys have already learned from the bus 254. So we cannot skip that part because some students have taken that courses a long time ago. So maybe it's you already forgot about this. So I guess we start the semester with reviewing all these cost accounting fundamentals. We understanding that the accountant's role in decision making. So we know that the not only the financial accountants, right? You are preparing financial statements for the external users, investors, creditors, but also you may be a management accountant, right? You may be prepare information for internal users, right? And then for the course, it's managerial accounting. So our focus is on the information managers will use for internal business decision makings, right? And some of the cost terms would be right the direct materials, direct labor, overhead, variable cost, fixed cost, right? A very important analysis is called a CVP analysis, right? That's basically based on the format that revenue minus variable cost equals contribution margin minus fixed cost equals operating income. So based on that format, there is a break-even analysis, right? This tells me how many sales, right, in unit or dollar amounts I have to make in order to break even, right? And then we also introduced with margin of safety and operating leverage. Right? And then we learned about the job costing, right? This job costing is particularly suitable for those business industries that their output, right, either the service or the product, the output is very unique, right? It can be distinguished from each other. So then you just need to keep track of the amount of materials, the number of the labor hours, or you need to allocate certain overhead to this particular job order, right? So that's how you know how much that job cost you. And then the important calculation is that predetermined overhead rate, right? So you need to know what's the total overhead cost, and then somehow you need to identify allocation base, right, for your overhead. Oftentimes it could be the direct labor hour, direct machine hours, right, or maybe the production volume. Those type of possibility for the candidates for the allocation base, right? And then you just use a division, you calculate it, what is the predetermined overhead rate. ABC costing, if I can just use very simple language to say, is that it's multiple cost pools and you can calculate multiple overhead rate, right? So the idea is this one will better capture the overhead allocation, right? Really depending on how the resources is used, right? So when you have multiple pools, multiple rates, this approach will better, more accurately reflect the resources usage and correspondingly the cost allocation, right? The disadvantage of ABC costing, of course, it's going to involve the more calculation, right? Other than one single cost pool. So this would be the basics, right? The cost accounting fundamental basics. I don't worry too much about these topics because this is the second time you have learned this, right? So I think you guys probably know these topics are really well. And then moving to the next part is the tools for planning and control. Tools for planning and control. For planning purpose, budget, right? So before the start of the new fiscal year, the management need to start planning. What is the budget, right? What is the budget? So we know we have a master budget, flexible budget, and we analyze the variances, right? Because after the whole year, you have actual results, right? You're going to compare actual results with the budget numbers, and the difference would be the variance, right? You want to analyze this variance to get the information, right? What you did well, what need to be improved, right? So we know that static budget variance, basically you use actual numbers compared to the static budget. That is your static budget variance. And that variance can be separated into two variances, the sum of two variances. So flexible budget variance and sales volume variance, right? So what's the flexible budget variance? Flexible budget variance is actual result compared to the flexible budget, okay? What's the sales volume variance? This is a variance due to the changes in the sales volume. And sales volume variance can be further broke into the sum of sales mix variance plus sales quantity variance. Right? And then we learn about, under the flexible budget variance, we learned about all this direct variable rate and the efficiency variance, right? So either direct materials rate, right? So materials rate variance, materials efficiency variance, labor rate variance, labor efficiency variance, right? And then moving to the overhead, you have variable overhead variance versus fixed overhead variances, right? If you remember, I help you to create those graphs, right? Basically, you set up all these columns, right? And you know that how to calculate the difference variances. And then moving on to the income effects of denominators level on the inventory valuation. This is the time what matters is that how do you define fixed overhead, right? How do you define fixed overhead? Is it a product cost or is it a period cost? If it's a product cost, we're saying that this would be the absorption costing. If you consider fixed overhead as a period cost, that would be the variable costing, okay? And that matters because basically fixed overhead will be immediately recognized as expenses on the income statement if they are treated as period cost. However, if the fixed overhead is treated as product cost, right? So it's gonna first going into this inventories, right? So it will first go to the inventories, and then, right, you have the work in process inventory, you have the finished goods inventory, and then this cost will reach income statement until this product, finished product, was sold, right? So then the fixed overhead will be part of that cost of goods sold, right, on the income statement. So you can see that that's the difference. Because of this difference, often case your operating income under variable costing versus absorption costing will be different, right? So basically, the differences can be explained by the changes in the inventory level, right? By the changes in the inventory level. And there's a formula on that. And we have tested those formulas to be correct in the class, right? Using some examples. So basically, so this is important. And if you still remember, depending on the relationship between the production and the sales volume, right? We were saying when the production equals sales volume, the inventory level doesn't change. So in that case, the income level would be the same under both costing method, right? So this is the tools for planning and control, okay? And now we are learning the cost information for decisions. Okay, so what kind of decisions? So we are analyzing the cost of behavior. So the high-low method and regression method, right? We want to make decisions such as outsourcing, sell or process further, accept or reject a special order, retain or replace an old asset, right? This is all the decisions we need to make. In order to make those decisions, we need to analyze. So relevant information, right? What is the relevant information, right? So you have different alternatives. Relevant information would be those ones costs will incur and also differ among the different alternatives. Okay. We also learned about opportunity cost, right? And sunk cost, right? Sunk cost is never relevant to decision making, right? Because you are making decisions, with a forward-looking type of perspective. The sunk cost was the past cost. And pricing decisions, so you need information, cost information to make a decision to set up the price. So basically, there are different two major approach. One is the target costing. So basically, this happened in a very competitive market, right? You know what's the market price is. This market price is determined by the basics of economics, right? The supply and demand. So no single player will change that price. So that's in a competitive market. So the price is set up. We call that price a target price, right? And then you know what kind of margin you are trying to make. So you work backward to figure out what is the target costing, right? You have to keep your cost under that number, right? And then if the market is not competitive, so the cost plus costing will be appropriate, right? Basically, you figure out how much it costs you, right? And then you add the desired return, and that will be the price you want to set up. The example I gave in the class would be the technological companies like Apple, right? How they set up their price for the iPhones, right? And the return on investment, this is basically an income number divided by an investment number, right? Return on investment. And then we move further. We are talking about strategies, balance scorecard, and profitability analysis. Okay, so what are the four main perspectives of the balance scorecard? You have the financial, internal process, and the customer and the learning growth, right? So basically, we are saying how these are connected. So if your employees, right, you value them, you train them properly, the employees wants to stay, they are happy, they learn and they grow. So what happened is your internal business process will be very efficient, will be very attractive, right? Just because you have very motivated employees, and they will be very actively involved in that internal business process, right? So you are more likely to have success in that. And then your customer is happy, right? Because they are serviced well. You deliver your orders on time. You speak nicely to them, right? So the customers will stay with you and they would refer new customers. As a result, your sales will increase, your financial prospect will improve, right? So you can see that we should not only care about the financial measures. There's this non-financial measures are also really important in order for business to success. Just because these non-financial perspectives will eventually affect your financial prospect. Strategic analysis of operating income. Okay, so basically, when you are comparing your operating income year by year, right, you can see there is a difference. Either it's an increase or it's a decrease, right? You are hoping that it's an increase, and then you want to know, even it's an increase, you want to know what causes it, right? So there are three components: growth component, price recovery component, a productivity component, right? when you think about the growth component, this is really about the sales volume, right? So this is on the revenue side, right? So sales volume increase, that shows that this is a growth component. The company is growing. They have more clients, right? More customers. And then price recovery component. This is about the price, right? There are two prices, selling price, right? Versus your purchase price, right? So how does that change, right? Are you able to buy cheaper, right? Maybe your income improved because you are able to buy cheaper, right? Or maybe you can sell higher. Your product is very unique. Your customers, they accept the product at a higher price, right? So that would be that component. How does that price changes on the selling side, on the purchasing side, will affect your operating income. And then productivity component. This will be on the cost side, right? If your productivity improved, right, your cost is likely to be reduced, right? So maybe before you need to hire 10 people to do a job, and now due to the improvement on your productivity, you only need 8 people to do the same job, right? So then your payroll cost will reduce, right? So you can see productivity component that does not affect the revenue side. It's only affect the cost side, right? And then how can you tease out these 3 components, right? There are the formulas. Cost allocation and revenue. So period cost applications. So previously we talked about mostly concerned about product cost, right? Now the period cost application. So you could set up your 2 pools, right? You could have only one cost pool, and you set up the base, and then you can have a single rate, right? For using that to allocate your period cost. But you could also use dual rate, right? So you separate your total cost into a variable pool versus a fixed pool, okay? And then you are able to have a dual rate, okay? You are able to have a dual rate. And then we are talking about between different departments, right? You have supporting department versus the operating department. How are you going to allocate the period cost incurred in the supporting department? You have to allocate that cost to the operating department. So we learned about the 3 approach: direct approach, step down versus reciprocal, right? And then there are common costs. How do you allocate a common cost to different users, different departments? You can use standalone and incremental. Cost allocation in a situation where you have joint products and byproducts, right? So there are different ways to allocate the common cost, right? There's the common cost. So the physical measure, this could be the volume, the weight, right? Sales value at split off method. This is the most preferred method, right? If the selling price is available at split off point, right? If not, you could also move down to net realizable value. So this is a situation. The reason why this sales value is not available is that these things are not sold in the market, and the people don't throw it away, right? But then how did people do it? People will further process it, right? So people will further process it with a separate cost into another product, but that final product will be sold, right? So then we will calculate what's the net realizable value using the sales value minus the separate cost. So then you calculate backwardly what's the value at the split off point. And based on that, you are able to allocate the common cost. And the last one is the constant gross margin per percentage. So this is the case you first calculate what is the gross margin, right? What is the total revenue? What's the total cost? What's the total gross margin? and calculate that gross margin percentage. And then for each product, right, what is the total revenue? And then times the gross margin percentage. And the difference would be your cost, right? The cost of goods sold. And then that cost will have two components. You minus your separable cost. Then whatever left is the portion of the common cost allocated to the product. Revenue and the customer profitability analysis. We learned about the sales volume variance equals sales mix variance plus sales quantity variance. Okay. We do consider about the customer profitability analysis. So you cannot have a customer profile, and you're keeping track of the revenue received and the cost allocated, and to understand how profitable you are from you can make from the customer. But there's a lot of other factors you have to consider, right? You can't just focus on that number, right? There's lots of other factors need to be considered. Okay, and process costing is in the opposite to job costing. Process costing is appropriate in a situation where the output is in large volume and the product is indistinguishable from each other. Right? So for process costing, you have to make sure understand that the important part is about the working in process inventory, right? The WIP inventory. And then you have to be able to understand how to calculate equivalent unit, okay? And it's interesting because the opening versus the closing, that calculation is a little bit different, right? So the weighted average method, FIFO method, right? Those are the two methods you can use to calculate and allocate the cost to ending level versus the cost transferred out, right? The transferred in cost, this is important when you have different department. Maybe the production line is in a sequence. So you transfer out from one department and transfer into the next department. So when the next department received the transferred in, this transferred in is deemed as direct materials that has added 100%, okay? So that's very important. Control and budgeting strategies. We focused first on the inventory management. So we learned about that EOQ model, right? I explained to you how to use the formula to do the calculation, right? And also the safety stock, right? The safety stock. I go through a table. So when you have different level of safety stock, how does it impact your total cost, right? So so that's basically about inventory management. Capital budgeting. This is a little bit overlap with finance. The different methods you should know as accountant. NPV, net present value, internal rate of return, payback period, discounted payback period, accrual, accounting rate of return, right? This four method you should be very familiar with as accountant. And then we learned about transferring pricing, right? Transfer pricing could be on the market based. So how much, right? You have different units within the organization, right? So one unit's output probably can be the next unit's input. And there's also in the market. The question is, when you transfer the units, the output from one unit to the next unit, what price you're gonna set up, right? So if you set up too high, and then the purchasing unit, buying unit will say, well, guess what? I'm going to buy from the market, right? I'm not going to buy from you because you are charging higher than the market, right? And then if it's too low, then maybe the price does not even cover the cost, right? So that's not good. So you can think about there will be a minimum transfer price versus a maximum transfer price, right? Negotiated price would be anywhere between, right? Dual pricing would be that the organization will give market price to the selling units and a cost price to the buying units, right? But there is actual, this is going to cost extra money. Who is going to bear the cost? So the corporation, the big corporation as a whole is going to bear that cost. So that's the transfer pricing. Last week, we also talked a lot, actually, about multinational management control system, performance measurement, right? We talked a lot of very conceptual, very interesting and important cost. So these two chapters will now be tested in the exam, okay? Okay, so let me see. So far, everyone feels good. So I used, let me see. I used about half an hour to quickly go through all the topics we learned this semester. Does anyone have any comments, any question? No? Okay, so I will continue with the questions students ask. So I received only one email before the deadline. So the deadline was Sunday evening, midnight. So before that, I only received one email. Hello, professor. I was wondering if you could go over how to solve assignment 10, chapter 20, and 21's problem 21-38 in Wednesday's review lecture. Best regards. Okay, so I'm gonna just work on this. So for the, there are 3 questions for assignment 10. The last question is very similar to problem 21-38. So what I'm gonna do is I will cover the first 2 questions of the assignment, okay? And then I will cover 21-38. So in this question, this is about EOQ, right? So basically, this is a question asking you to calculate what is the EOQ, right? And then we know the formula, and I also explained, I have a video to show you why this formula is right. So you should use the formula with full confidence. So here we have the EOQ equals 2dp over c square root. We need to understand what does each symbol represent. D is the demand. P is the cost per purchase order. C is the carrying cost, okay, per unit. So in this question, we know the annual demand is 44,200. So that's my D. Okay, that's my D. And my ordering cost per purchase order is 170. So that's my P. And my carrying cost per year is $10 per jersey. So that's my C. So when you bring all these 3 numbers into this formula, you will calculate your EOQ is 1226. So every time you are going to order 1226 jerseys, okay? According to this EOQ model, that will keep your total cost minimum. Required to calculate the number of orders that will be placed each year. Okay, so you have a total in the whole year, you are going to sell 44,200. And for each order, you ordered 1226. So how many orders you need to make? Use the total divided by the unit for each order. So that will be the total orders required. So it turned out to be 37 orders. Requirement number 3, calculate reorder point. So in this question, we learned that the purchasing lead time, is 7 days. And the company is open 364 days a year, right? So then I'm calculating, okay, in the whole year, I'm selling 200 units. And every day, on average, I'm opening 364 days. On every day, I'm gonna sell 121, 43 jerseys, okay? So on average, every day I'm selling 121, 43, okay? So how much you gonna sell in the 7 days while you are waiting, right? Because your purchasing lead time is 7 days. So this purchasing lead time means this is the time waiting from the time you make the order, you make the new order, and the items arrive to your inventory, right? So every day, on average, you are selling 121 and 43 jersey. And in a week times 7, right, you are going to sell 851. So this is the reorder point, is that when your inventory level reached this 851, you need to make a reorder. Otherwise, your inventory will not last for 7 days, right? So basically, it could happen that there are empty shelves, right? There are certain time that your shelves are empty. Right? So does anyone have any question about this this question? If you understand this, give me a thumb up. 1, 2, 3. Thumb up. Yeah. Okay, awesome. You guys all got this. That's great. Okay, so this is my first question, and my second one. Okay, so this one is that you have 2 suppliers, right, of footballs, Big Red, Quality Sports, right? You have these two suppliers. Basically, you want to know what is the cost, the total cost from purchasing from these 2 suppliers, and which suppliers you need to work with, right? So you have 2 potential suppliers, and then you're going to make a decision which suppliers you want to work with, okay? And the point would be that whichever total cost lower, that's one I'm going to pick, right? So which suppliers will make my total cost lower. Okay, so that's the point. So here, when we analyze the cost, there are different costs. There are different costs, right? So you have a purchasing cost. So this one is calculated by your units in demand, 12,000, times selling price. That's my purchasing cost, right? That's the cost of buying this goods, right? So 12,000 times 60, that is my 720,000. 12,000 times 61.2, that is my 734,400. So this is the purchasing cost. Inspection cost. So you can see inspection cost for big red, this one is 2 cents. For quality is 0. Okay. So I'm purchasing 12,000 units. Each unit is going to cost 2 cents to inspect. So 12,000 times 0.02. So that's my 240 inspection cost. And the inspection cost is 0. There's no inspection cost. So that's 0 for quality. What is the stock cost? Stock out cost. So stock out unit per year, right? If you work with big red, you need to stock out 350 as a buffer. But for quality, you only need 60, right? It's probably because big red, right, and quality, they're different companies. It just may be that, the quality, they have sufficient production. So maybe you can keep a low level of stock out units. But the big red, in order to address the risk, it's better for you to keep a higher level stock out, right? So that could be the difference. And the price is $24.12. So I'm stocking out 350 units. Each unit costs 24. So together, that's my 8,400. $12 times 60, that's my 720. And what is the return cost? Customer returns 300 units. Cost per return 30. So 300 units times 30, that's my 9,000 return cost. For quality sports, this is 25 units times 30. So maybe this is the quality sports. Maybe this product have higher quality. Therefore, the return rate will be lower. So only 25 units is returned, and the return cost is 30. So 25 times 30, that is my 750. Right? And other carrying cost, insurance. So insurance, $4 per unit. For big red, $4.5 for quality sports. And the average quantity of inventory held during the year. So on average, the inventory is held is 100. So each unit per year, the insurance costs $4. So $4 times 100. This is my 400. And 4.5 times 100. This is my 450. And the next one is the required annual return on investment. So you are carrying 100 units, right? You are carrying 100 units, and you pay $60 per unit. So basically, the average inventory level would be 60 times 100, 6,000, right? So on average, your inventory cost is 6,000. If you don't carry this inventory, what is your opportunity cost? You're going to times 15%. So 6,000 times 15%, that is my $900 opportunity cost. So this tells me that if I don't carry inventory at all, I can make $900 elsewhere, right? So this is a lose of my opportunity cost. And then you use this number times 100 times 15%, slightly over 900, 918, right? So now this is all the costs. You add them up, you compare the total cost. So we compare the total cost. It's cheaper if we go with quality sports, and that's the answer, right? They should buy from quality sports. Okay, does anyone have any question? Okay, so if you understand this, give me a thumb up. 1, 2, 3. Okay, awesome. I think you will all do well in the final exam. And for this question, the third one of the assignment, I'm going to, this one is very similar to problems 21-38. So I'm going through this question instead, okay? So this question is pretty straightforward. They're considering to buy a new machine, right? A second-hand machine to increase their production. The cost of the machine is $80,000. If you have this machine, you're gonna have an increase in the annual contribution margin of 15,000. The life of the machine is 10 years. Required rate of return is 6%. Yummy estimates they will be able to produce more candy using the second machine, thus increase their annual contribution margin. They also estimate there will be a small disposal value of the machine, but the cost of removal will offset the value, right? So at the end of the 10 years, they probably will be able to sell it for a little bit value, but there is also the cost of removal, so they offset, right? Ignore income tax issues. So basically, we don't consider the present value of the CCA tax shield, right? So I promised you in the class that I will show you the calculation. So I did upload a document to show you how to derive the formula for the present value of CCA tax shield. I also make a video, okay? I posted also on the channel about how to derive this formula. If you are interested in that, please take a look. Otherwise, I can tell you that this is not something I'm going to test you in this exam. Okay, so we assume all cash flows occurred at the year end, except for the initial investment amount. So this information is important, right? So all the cash flows occurred at the year end. This tells me that the annuity, right? There are 10 years of $15,000 annuity for 10 years. This cash flow is always at the end of the year, right? So we know that this is the ordinary annuity, right? If the cash flow happened at the beginning of the year, that will be a annuity due, right? In the finance, you learn that. So let's see how we're gonna calculate the net present value. So first, I am going to, okay, so just give me a second. I'm going to draw this timeline. Okay, so I have year 0. You have a cash outflow. You paid $80,000 to purchase this second-hand chocolate machine, but it's going to help you with the future contribution margin. So every year, okay, you're going to have an increase in the contribution margin of 15,000 for 10 years. So that'll be a cash inflow, right? A positive number. So to solve this, we need to look up the present value of annuity, ordinary annuity table. We learned that the discount rate, the required rate of return is 6%. So this is the column I need to focus on. And we know that the number of years of the annuity stream is 10 years. I need to focus on this row so I can see the column and the row they cross at 7.36. Okay, So this is the discount factor for the annuity, 6% and 10 years. So that's going to be, so that's going to be 15,000. That's the cash flow times the discount factor. This is my cash inflow, and at the year zero, present value is negative 80,000. So in the end, I have a positive 30,400. So this is a positive net present value. Should I take on this project?
Hey, Prof, I have a quick question.
Yeah.
How do you determine which table to choose? What information guides you towards it?
Well, this is annuity, right? There are 10. This annuity means it's a equal, this is an equal payment, right? Equal cash flows for multiple years. Instead of discount each of them in a single year, right? That will be too much work. Instead, you don't use the first table. You use the second one. It's called the present value of the ordinary annuity. So this is the one that will help you to do all these cash flows at the same time.
Okay, so should we care about the distinction between beginning of period and end of period?
Yeah, if it's at the beginning of the period, it will be a different table. It's not this table. Yeah.
Okay, so this one is the one you be used at the end of the period.
Yeah, this is the table that is called ordinary annuity. And then there are three tables. The first table is the present value, right? Of just one single cash flow. And then you have this ordinary annuity, and then you have annuity due, right? So there are three tables.
All right, sounds good.
Yeah.
And in the exam, you're going to expect all three tables, or
I will give you the three tables in the exam. Yeah.
Okay.
So anyone else have any question? So if you understand this question, give me a thumb up. 1, 2, 3.
Could you show how to do it if the percentage was like 7% instead of like the even numbers, if it was an odd?
7%?
Yeah.
So we don't have that in this table. So therefore, I will not ask a question like that, right?
Okay.
Yeah. There are formulas, right? But I don't think I want to add that to the requirement. So basically, I will give you the table, but I will make sure that you can just use the table to get the information you need. In the finance, there are formulas. You can just any interest rate, right? Any discount rate, you can always calculate, right? There's formulas, but that's out of the scope of this course. Okay, we'll move on to the next one. That'll be the payback period. Okay, so payback period. So this case is 15,000. It's a uniform cash flow. So payback period is easy to calculate. So use 80,000 divided by 15,000. So it take me like 5 1/3 year to get back my investment. Discounted payback period. So you have to draw this table, right? So basically, these cash flows will be discounted every year. So I know that, why? I know that the discounting factor are this, right? So how do I know this? This discounting factor is just coming from, okay, so let's see, from here. So 6% and period, right? So these numbers, you can see. So this is a discounting factor for present value of $1, right? So I'm going to, yeah, so these are the numbers, okay? And then each year, you're gonna discount the 15,000 by multiplying this discounting factor. So the first year, and then second year, so every year, the discounted cash flow is this much. So I use 80 minus this 14,145. This is the ending at the year 1. And then I use this one minus the second year's cash flow, discounted cash flow. So this is the ending balance of my year 2. So I keep going. So at year 6, my remaining balance to recover, the cost to recover is 6,245. And in year 7, that discounted cash flow is 9,975. So basically, before the end of year 7, I already fully recovered that cost. So there's a partial year calculation. So I use the cost to be recovered, okay, for the year divided by the total discounted cash flow. So this 0.63, this is the partial year. And then before this partial year, there are 6 years. So therefore, the discounted payback period is 6.63. You can see this period is longer than this payback period, 5.33. It's just because when you discounted the future cash flow, it's going to take you a longer time to recover all the cost, right? So therefore, our result is reasonable. If you understand this, please give me a thumb up. 1, 2, 3. Okay. Okay, so this is the...
Sorry. What is the explanation of discounted payback period? How to describe that percentage? Or is it a percentage?
Payback period is the number of years, right? So here, we are saying if it's payback period, it's going to take 5 years and a third to recover all the cost. But if you discounted the future cash flow, the discounted payback period is going to be 6 years and 0.63. This is the partial year.
Okay, so that would be how much we should how much period we need today, right?
Yeah, how many years, right, to recover the cost. Yeah.
All right, that's good.
Okay, so next. When we think about the internal rate of return, we just use the goal analysis. So you set up your initial investment, annual cash flow, n equals 10. And then you build up your net present value using this information. This 4 information, you build up that formula. And then the goal seek, you set this to be 0 by changing this rate. So, and then the Excel will just automatically calculate. It turned out to be 13.43%. Accrued accounting rate. Accrued accounting rate, right? So this one is based on the return on investment, right? So you use your income divided by your investment. This is the accounting measure. So you know your increased annual contribution margin is 15,000. You have a depreciation. It's a straight line depreciation. So 80,000 over 10 years. So each year is 8,000. So my income is 7,000. So income is 7,000. my investment is 80,000. So my ROI is 8.75%. Okay, do you guys have any question about this? If you understand everything, give me a thumb up, please. Okay, does anyone have any question?
How did you get the depreciation value?
It's the total value divided by the 10 years, which is the useful life. Any other questions?
Just a quick question, Professor. Since we've been doing the internal rate of return using Excel, would we be expected to calculate it on the final exam by like using the guessing method?
It's pretty challenging because you are not allowed to use your laptop, use your Excel, right?
Mhm.
So I guess I can just tell you it won't be ask you to do the internal rate of return, but in the finance, right? You need to know that, and also just in general, right? As a CPA student, you want to know how to do this. Yeah.
Okay, perfect. Thank you.
Yeah. Any other questions? Okay, so next question is what other factors should Yami Candy consider in deciding whether to purchase the new machine? What other factors? So here is the availability of capital to pay. So that'll be this one, right? That'll be related to this. Do you have the money to pay for this? Sure, it sounds to be a good project. Your required rate of return is 6%. This project has a over 13% of rate of return. Sure, it's a good project. You should do it. But now, do you have this $80,000? Okay. And then, is this the only cost? Are there any hidden cost? All the costs here covered by the 80,000, right? Because if you have any additional cost, it's going to lower that internal rate of return, right? So, and also, is this really 10 years, right? Because if you last only 5 years, this internal rate of return will be lower, right? You can see that this is a question mark. This is the question mark. And are there additional benefit other than this, right? Maybe it's not just this financial benefit. Maybe it's also do good things for the customer, for the internal process, right? Okay, so does anyone have any question? If everything makes sense, give me a thumb up, please. You can see that I need a lot of encouragement. Okay, thank you. Okay, so this is my official review. So what I'm gonna do, I'm gonna stop